Financials underperforming the broader market this year, with the sector down nearly 19% year to date. But our next guest says the Fed's recent shift to average inflation targeting without any indication of yield curve control could lead to a bullish outlook for the sector. Joining us by phone now, Mike Wilson, Chief U.S. Secretary Strategist at Morgan Stanley. Mike, thanks so much for joining us. I guess the other point really is that the banks themselves within the financials are down much more than that. They're down 32% year to date. But before we get to the call, what do you think the implications are from what we learned from the Fed last week for the yield curve and for inflation?
Yeah, thanks, Will. Thanks for having me. I think that is kind of the reason, why kind of step into this pool today. I think the Fed has done a really good job of doing their role of providing support to the markets, making sure, credit and equity markets are operating well. They're providing support to the economy through various programs. And then last week, of course, they gave us this next step, which is basically telling us they're not going to be raising rates anytime soon because they're targeting higher inflation. So even if inflation were to show up, which we think it might, they're not going to react to that on the rates front. And then, of course, on the other side, the idea that they were going to pin rates at the back end, there was always people holding out hope for that. They kind of threw cold water on that, not once, but twice, right? The Fed minutes in July told us that. And then last week, Chair Powell had an opportunity to kind of back that down, and he didn't. So I think the message is clear. And by the way, I don't know why the Fed would fear back-end rates moving higher if they're going up because we're having a robust recovery, which is what's going on. That would be helpful to their cause, which is that they want money supply growth. They want the banks to do well. And, look, a flat yield curve does not help them in that regard. So it really does seem like there's a shift there. Markets did react a little bit initially last week, and then now they've settled back in again. Rates are back down below 70 basis points in the 10-year. But I think the step is in the right direction. And at the end of the day, I don't see a whole lot of downside, that's for sure, on 10-year yields, given the outlook that we see for the economy.
I guess, Mike, clearly there is therefore scope for rates to be able to be permitted to rise if the ingredients are there. But we've had a lot of false dawns for whether rates will indeed rise, and with that, a lot of false dawns for whether banks are due to rally. What is going to be the meaningful trigger or catalyst this time that actually means that's a big change that lasts as opposed to just a flirtation with it?
Yeah, I think it's a good point. First of all, longer term, who knows if we're ultimately successful in changing the dynamics here. But even in the last, recession and recovery, the great financial crisis, rates did have a pretty powerful move in 2018, of course, after the tax cuts and the economy got booming again. And that could be a similar scenario next year, right? If we get this CARES Package 2 passed, we get, into next year, we have a vaccine with herd immunity, perhaps a combination, the economy continues to reopen, get the election behind us. That's a big, I think, overhang. You could see rates up pretty significantly on just better growth outlook. And the break-evens market, as you know, has been sort of reflecting better growth and expectations about inflation next year already at 180, 185 on a 10-year break-even. So the ingredients are already there. If I go one step further, a lot of the equity market beneficiaries of higher rates, things like commodity, material stocks, industrial stocks, small mid-cap companies, they've been performing exceptionally well since the lows back in March. And if you look at commodities and gold and things like that, they're all telling you the same message. The only instrument that has not kind of confirmed that is 10-year nominal yields because of this belief that the Fed wants to pin rates or is going to pin rates. But they didn't really tell us that last week, did they?
No, so I want to get to what it all means for stocks, Mike, and your overall call, especially because I feel like we should give you big props for coming out in March and saying best risk reward in years, really calling the bottom and having a tremendous call. Now that the market is up almost 61% from those March lows, are you telling investors to still keep buying stocks here?
Well, look, first of all, thanks, Sarah. But the reality is we've come a long way in a short amount of time. And if I'm honest, there's no way I thought we'd be this far along this quickly. I thought we'd be in this direction. We've overshot some of our near-term targets. But hey, that's a good thing. I think it's happening for the right reason. And the right reasons are that the recovery itself, I think, is happening faster. The support mechanisms that were put in place are working. And then the big story that we're getting more excited about now is just the operating leverage that we see in companies next year as the economy comes back. We're already seeing early signs the operating leverage coming back with just a small snapback for companies that really cut costs in this recession. That's typical, but the cost cutting this time around is probably going to be even more significant. So look, I remain very constructive over the next 12 months. I think we're a little bit overcooked. I know you guys were talking about that before I jumped on. I agree. Nope, it's impossible to try and time these types of corrections. Would not surprise me if we got a 10% correction, but it wouldn't surprise me if we didn't either. I mean, it's a bull market. I think the main message from the market is it's the best leading indicator out there, and what the market is telling us is that 2021 is going to be a pretty good year for the economy and for earnings.
Mike, pivoting back to your call on the banks, two potential risks for them and your level of concern for each. One is if we do get that broad tech market pullback from outperformance, does that hurt the banks too, even though the banks haven't been part of the recent melt up? And number two, the election. Would a Dem sweep hurt the banking sector much more than other sectors?
Yeah, well, let's talk about the second one first. I mean, this is, I think, another big overhang. One of the reasons why banks have not done well is because 10-year yields have not, moved up, even though other early cyclical sectors have done exceptionally well. But the other overhang, as you point out, Wilf, is, a blue sweep, and that's what the market is somewhat pricing. And the idea that regulatory, environment is going to get worse. Well, first of all, I would say the regulatory environment, for all of the hoopla, has really not improved that much. I mean, there's still a lot of constraints on banks for the most part in terms of their ability to return capital and things like that. So I'm not so sure that it would be that much more onerous at the end of the day. Secondly, the polls are tightening in the last week or two. I know you've been talking about that as well. And so there is even if the chances of a blue sweep go down, that could be another reason why you get that regulatory concern to be lifted in the short term. As far as the rotation goes, I mean, look, I don't think the tech stocks have to necessarily get killed for bank stocks to work or vice versa. I think the reality is that it's been a pretty broad rally since the lows. We are now looking, because the rally's been so sharp and persistent, we're looking for areas that have been somewhat left behind. And that's really the call behind, on the financials call this past week. There's a group of really good earnings. The quality of the companies is much better. We're pretty, positive on rates moving higher, pretty positive on the economy. And so that's a pretty good pitch for us from this point.